Good morning, all. It's good to see so many of you joining us to hear our analysis from our experts on a budget that held quite a few surprises. So my name's Tim Stovold. I'm one of the tax partners at Moore Kingston Smith. I'm sure most of you are familiar with the firm, as I can see lots of regular names on the attendee list. However, for those of you who don't know us so well, Moore Kingston Smith is a top 10 tax advisory and audit firm working across all industries, not-for-profit organisations, and looking after private clients as well. We're part of Moore Global, an international network with presence in over 100 countries as well. So yesterday, we had what we expect to be the last budget before the election. Normally, these budgets include something for everybody to increase popularity ahead of the population casting their votes. But expectations were managed in the run-up to budget day, as we were told there was little fiscal headroom for bold moves. That said, there was a bit of give, and as well as a fair amount of take. So as ever, the devil was in the detail, so I'm delighted to be joined by my fellow tax colleagues, Nick Blundell and Katy Shaw. Nick is a specialist in all things relating to corporate and business taxes, and Katy's one of our private client experts. My job would normally be to cover the employment tax related issues, but as the budget was a bit light on this area, I'll be keeping an eye on your questions as Nick and Katy run through the detail, and I'll pick out the most difficult ones to ask them. Please, just a plea to the attendees, please put your questions in the Q&A log rather than the chat, and I can then weave those into the presentation as best as I can. It's just a little easier to keep track of them in the Q&A log. So with the scene set, and hopefully the technology is all working, I'll hand over to Katy to get started.
Thanks, Tim. Good morning, everybody. Nice to see everybody here today. So as Tim said, I'll be talking through the personal tax aspects of yesterday's budget. So I'll be going through most of the announcements there that affect individuals. So starting with NIC. So the biggest tax saving measure that was announced yesterday, and it was trailed in the days leading up to the budget, was a reduction in Class 1 NIC for employees. So a little bit of deja vu from the autumn statement a few months ago when there was a similar reduction in Class 1 NIC announced. So currently it's 10% on earnings between the primary threshold of 12,570 and 50,270. So currently 10%, there's going to be a 2% drop in that from this April to 8%. And that falls from 12% that was in place a few months ago. So a fairly reasonable drop in Class 1 NIC. To give an example of the saving, so for an individual who earns around £75,000 a year, that represents a saving of £754 and a total saving of around £1,500 from around 12 months ago. There's no change to employers' NIC, so this is just primary Class 1 NIC. Moving on to NIC for the self-employed, so as you're aware, so Class 4 applies for self-employed individuals, and that will be reduced from 9% to 6%. There was already an announcement that it would reduce to 8%, but now it's going down to 6%. On profits between 12,570 and 50,270. Announcement already made was Class 2, so the weekly flat rate of £3.45, that's being abolished also from 6 April 2024. So a fairly reasonable saving there in NIC for the self-employed. To give an example there, so £650 for an individual on who earns around £28,000 per year.
Katy, we've just had a question in, and probably one looking a bit further down the track, but because there's a saving in Class 4 national insurance that is paid through self-assessment, is this an opportunity for people to reduce payments on account they're making?
Yeah, it could be, yeah, because the saving total is about £1,000 when you look at it in total. So it could be an opportunity to reduce payments on account that are due in January 25 and July 25 for the 24-25 tax year. But you've got to be a little bit careful because interest at the moment is quite high. It's over 7%. So if you do end up with a balance in payment, you've got to pay interest. So yeah, tread carefully, but in theory, yeah.
Okay, thank you.
Yeah, so the NIC savings, yeah, welcome change, but It's not a change to income tax. It's not a decrease in income tax. So it doesn't benefit individuals who have investment income or property income. It's just tax on earnings. Moving on to capital gains tax. So from this April, so from 6 April 24, there's going to be a change in the top rate of capital gains tax on residential property from 28% to 24%. We weren't quite expecting this change, but it seems to be designed, along with some other measures that we'll touch on later, kind of stimulating housing supply, especially potentially to encourage sales of properties by landlords and second homeowners. So yes, there's a reduction there. And the table below just summarise the current CGT regime. So if we just look at higher and additional rate taxpayers, so the main rate of CGT on all assets other than residential property and carried interest is 20%. Residential property dropping to 24% from this April, and carried interest remains the same at 28%. No changes to the 10% CGT rate under business asset disposal relief, so that regime stays the same. And also the annual exempt amount is falling to £3,000 from this April, from the current rate of £6,000.
So when we've got lots of attendees, Katy, I'll try and pepper the questions in. If I'm selling a property now, and not my main home, of course, as no one pays capital gains tax generally on selling main home, but if I'm selling a buy-to-let, I'm sure is where the context of this question is. Should I delay? Is there a saving in delaying until after the 6th of April?
Yeah, I think it depends. So if you're a basic rate payer, there's no change. So it's 18%. And also, if you sell this side of the tax year, end of the tax year, you get the £6,000 annual exemption. So you'll have to do the maths. But CGT is based on the date of exchange. So it just depends where you are and doing the maths. But for larger amounts, if you are a higher or additional rate taxpayer and it's going to likely fall into the next year, then you'll benefit from the 24% rate.
Yeah, so delaying maybe worthwhile. Good questions come in about what's the political rationale for reducing capital gains tax on buy-to-lets. I mean, the Chancellor said in his speech, he referred to the Laffer curve. A Laffer curve often referred to in tax circles, that the higher the tax rate, the less tax it collects. So the theory is that by reducing the tax rate, there'll be more liquidity in the property market, more properties will be sold, and they actually forecast 310 million, I think, from memory, additional tax being collected by a reduced tax rate. So it's a slightly surprising announcement, but that there was a theoretical logic behind it.
Yeah, I think that's right, Tim. Thank you. Okay. So just moving on now to the changes that were announced to the non-UK domicile regime, so the non-dom regime affecting individuals that live in the UK but have international connections and perhaps permanent homes in other countries. Perhaps stealing Labour's thunder in terms of non-dom changes, but the existing regime, so what we call the remittance basis regime, that is to be abolished from 6 April 2025. And instead of the concept being based on domicile, it's going to change to a new residence-based regime that's going to take effect. And there's going to be a new system for new arrivals into the UK that we'll go into a bit more detail on that in a minute in terms of what we know. It's a new system for new arrivals, and there'll also be transitional arrangements for people already living in the UK, so existing non-doms. And just to look at some of that detail. So new arrivals into the UK. So the plan is, provided that an individual hasn't been resident in the UK in the last 10 years, then what they will get is 100% tax relief on income and gains on the first 4 years of residence in the UK. And once they've been resident in the UK for more than 4 years, then it'll be full UK tax on all of their foreign income and gains. If an individual has, say, recently arrived in the UK, so let's say they arrived this tax year, but they've been here less than 4 years, then they'll also be eligible under this new 4-year regime. And one of the big benefits of this new regime compared to the existing one is that you can remit foreign income and gains into the UK with no tax charge, potentially bringing in, you know, more money and investment into the UK. These rules are going to have effect from 6 April next year. And what I think will be really interesting to see is, you know, how much they go in terms of encouraging international wealth and talent into the UK and how it compares with other friendly regimes in other countries. And from what we can see, so there's no charge to access this regime, but it does only last 4 years, which compared to other countries, the duration can be longer. So for existing,
there's a good question here, Katy, about why the change to the non-dom regime is starting in April 25 and not April 2024. I mean, I don't think there is a great deal of logic around it. Have you got any thoughts around that?
I think one of the complexity, and just to give time for people to plan, because the rules are quite complex. And, you know, as of a week or two ago, we weren't expecting the governments to announce this change. So I suspect that, you know, there's still a lot of thinking and consideration going on behind the scenes.
Yeah, the Chancellor did say in the speech that he'd been considering this change for the last couple of years, but he strangely didn't mention it until about a week ago. So I imagine it's just poorly thought out at the moment, and they're giving themselves time just to figure out the detail. It's a hugely complex area of the tax code. So just scrapping it overnight without some time just to think about all the implications is probably unworkable.
And just to run through what we know from the announcements yesterday on transitional arrangements for non-DOMs, so non-DOMs who are currently living in the UK. So there's kind of 3 main potential changes here. So the first one is in relation to foreign income that's generated in the 25-26 tax year. So the proposed measure here is that there'll be a 50% reduction in foreign income subject to tax. So that'll be a potential tax benefit in respect of that. The second one is in relation to unremitted foreign income and gains that arose before the 6th of April 2025. There's going to be a new temporary repatriation facility for 2 years that will apply a 12% rate on foreign income and gains. And then the last one is in relation to foreign assets that were held at the 6th of April 2019. So for sales of those assets that take place after 6 April 2025, there'll be a rebasing to the market value as at 6 April 2019. So these measures will soften the blow, if you like, for existing non-DOMs in the UK.
Yeah, sorry, Katy, just going back to that earlier question, you know, the concern that this is giving wealthy non-DOMs a year to plan their affairs and dodge this change somehow. Actually, it's probably the opposite, because this facility to repatriate at a 12% tax rate is something they'll be waiting for. And the real question is, if there's a change of government, whether these transitional rules actually survive a change of government, or whether if the government changes to Labour, whether they'll feel the need to toughen up and actually adopt an even tougher stance than the Conservative Party. So it's all a bit up in the air.
Yeah, no, I agree. And just linked to all of that, there's a final comment there on the slide about excluded property trusts and protected settlements set up for non-DOMs. And essentially, these are special types of trust that have certain favourable tax treatment for non-DOMs, particularly in respect of inheritance tax. There's some good and bad news here. Good news in that some non-DOMs can set up these favourable trusts before 2025, before the new rules take place. But for some existing trusts, what it means is that income and gains generated after 2025 will be subject to tax. So we'll watch the details on those, and I'm sure we'll be commenting more as these changes come into effect. So moving on to inheritance tax. So we were potentially expecting some changes to be announced on inheritance tax. There's been quite a lot of commentary on that recently, but no changes announced to the main rates. They remain unchanged. So 40% is the IHT death rate. 36% is the death rate where you leave 10% of your net estate to charity, and 20% is the lifetime IHT rate, so no change there. Similarly, no change in respect of the nil rate bands, so it's still at that level of £325,000 per person, and £175,000 of the residence nil rate band, where certain conditions are met. But what was announced yesterday, perhaps more a broader impact, is a consultation on how inheritance tax itself is assessed. So at the moment, inheritance tax is based on domicile and where assets are situated, and combined with the changes to the non-dom regime and this kind of phasing out of the concept of domicile, which is a common law concept, that is going to be removed, so that concept of domicile linked to IHT will be removed, and the likely change is that it will be based on residence instead. So to give you an example, there's likely to be a potential 10-year rule for incomers and leavers based on residence. So if you're an individual moving to the UK, say from India or Dubai or another country, then it would only be after you've lived here for 10 years that you would be subject to inheritance tax on your worldwide estate. And on the flip side, if you leave the UK, so Brits retiring abroad, for example, after you've left the UK for 10 years, then you wouldn't be subject to inheritance tax on your non-UK assets.
There's one question on this area, Katy. The 10-year rule, that was something that was hinted to be included in the consultation on this. I don't think we've actually seen the detailed consultation. So the question is, when do you think we'll get certainty on how the inheritance tax rules will change?
I think it'll take a while, just because it's quite a complex area, and the concept of domicile has been in place for decades. So there's a lot of legislation to be looked at. So we'll wait and see. Yeah,
I mean, absent the election, normally when we see a consultation these days, those who are in the tax profession, the consultation is less of a consultation, more of a this is what we're going to do. And very rarely do we see measures consulted on change. So for now, I would work on the basis the 10-year rule is the likely rule that would come in under a Conservative government. Again, question if there's a change of government, whether Labour would change that in any way.
Yeah. Some other inheritance tax measures. So at the moment, inheritance tax has to be paid before probate is granted and within 6 months. But from 1st of April 2024, personal representatives will no longer need to have sought commercial loans, potentially to pay IHT, before they can apply for a grant of credit from HMRC. So I think that's quite a welcome easing of some of the rules in that respect. Just another comment there, relief for woodlands and agricultural property. So there'll be changes introduced so that you only get inheritance tax relief on UK situated woodlands and agricultural property, which reduces it from at the moment where you can get relief on those type of assets in the European economic area and in the Crown dependencies as well. So it's just going to make it more UK centric. A big announcement yesterday, and I think quite a favourable one, a lot that's been, there's been a lot of campaigning around it, is the high income child benefit charge. So at the moment, parents, where they qualify, get £25 per week or for the first child and £16 a week for subsequent children. But it has to be repaid at the moment where one parent earns over £50,000. And that was seen as quite an unfair outcome, say where you've got two parents earning under £50,000 each, versus who wouldn't have any restriction to child benefit, versus say one parent who earned £50,000 a year. So the Chancellor's listened to the campaigning in that respect, and the high income limit will be increased from £50,000 to £60,000 from this April. And then child benefit will not be fully withdrawn until income exceeds £80,000 from its current rate of £60,000. So there will be a more or less immediate relaxation in those rules, which is quite favourable. There will be a consultation, and it's proposed that from April 2026, that the limits will apply on a per household basis, which is seen as more equitable when you look at, the income per household, rather than looking at individual parents' income, where you can get these anomalies. So quite welcome measures being introduced there. Moving back onto property, residential property was certainly a topic of yesterday. So furnished holiday lets. So at the moment, various tax reliefs and benefits apply to the letting of residential properties as furnished holiday lets. So, you know, your holiday cottages in Cornwall or your Airbnbs, which a lot of people have invested in quite heavily over the years. Those favourable tax reliefs, at the moment, there's a 10% CGT rate on sales of FHLs. You can also qualify for capital allowances, and you can also get a full mortgage interest deduction in relation to furnished holiday lets compared to normal letting of property. Those rules are going to be abolished from April 2025, and so holiday lets will just be taxed like any other investment property. There are going to be introduced some anti-forestalling rules to prevent people doing clever things to try and engineer some kind of sale at 10%, to bank that 10% rate before the full rate comes in April 2025. So yeah, so the government are onto that one.
Okay, so Katy, a couple of questions on this area. So, I mean, this one is probably a fairly straightforward one. Presumably, the 10% rate is available for selling property before the 5th of April 2025, and it would go up to presumably the new 24% rate after that date. So selling before 5th of April 2025, are we certain at this stage that would qualify for the 10% rate?
Yeah, I think so. So I think if you were going to plan to sell anyway, and you sell before April 2025, normal transaction, and based on the date of exchange, yes, if it's before April 2025, you'd get your 10%. As I say, if you're trying to do something clever, like sell it to a trust that you can benefit from, perhaps not. But before April 25, 10% should apply.
And there's two questions on a similar topic, one I've not given much thought to, but so I did say I'd only ask you questions I think I know the answer to, but here's the first curveball. So losses brought forward on furnished holiday lets, and those losses would often be created with mortgage interest and capital allowances. Do we think there's going to be any restriction of those losses brought forward against future profits from those properties?
Yeah, that's an interesting question. Yeah. Don't know. We'll wait and see.
My gut feel is to ask a taxpayer to go back and recalculate their income in previous years when the rules hadn't been changed. I think feels fairly low risk. I would imagine the losses will still be capable of being brought forward. But because the 10%, the main thing, this is actually quite a clever move, because the 10% CGT rate will be lost, certainly lost 6th of April 2025. You know, a lot of people will say, look, I'm going to lose the mortgage interest relief. This furnished holiday let is no longer economic for me to own, and I'm going to pay a lot less tax by selling it before April 25. So it will release a lot of properties in those areas. Particularly, there was a lot of lobbying from the constituencies in Devon and Cornwall where locals have been priced out of the property market. So you know, this actually might be, although it's sad to see a tax regime we all knew and loved for a long time go, it's actually probably a pretty decent move.
Yeah.
To free up liquidity in the property market.
Yeah, I agree. Thanks, Tim. Just a point on ISAs. So to complement the range of ISAs that we already have, there's going to be a new UK ISA with a limit of £5,000 a year, and that's to encourage investment in UK companies. So that's on the top of the usual £20,000 ISA limit that's already in place for adults. Lots of questions coming out of this as to what is a UK company, you know, what's the design, when's it going to be introduced? The consultation has already been launched. So we'll just see what comes out of that in terms of, what qualifies as a UK company, etc. But it's quite a substantial increase to the 20%, the £20,000 that's already there. And then finally, from my side, just back to property again, SDLT. So there is a relief currently available, multiple dwellings relief, and that applies where somebody, say, buys a number of properties in a single transaction, and you get like an averaging of the SDLT rate that applies there. That is going to be abolished from the 1st of June 2024. But contracts entered into prior to yesterday's announcement will still attract multiple dwellings relief, irrespective of the completion date. There had been a consultation on SDLT that we're waiting, the outcome of, and this was one of those that came out of that consultation, and no other changes despite other kind of areas that have been examined quite closely recently, especially on like mixed use property purchases, like residential and commercial properties, mixed use. But yeah, multiple dwellings relief, yeah, that's going from this June.
Okay, thank you very much, Katie. So even though the budget speech was one of the longest ones I can remember, and we saw more paperwork come out of it, a lot of it was sort of filler, and the actual key measures are relatively well covered in that last session. So we'll move on from private client matters to corporate and business tax matters. We've quarantined Nick in another room as he's got a bad dose of the post-budget flu. So we'll keep him there. So Nick, I shall hand over to you. Do keep sending your questions in, even if they relate to Katie's session, and we'll weave them around or answer them offline. But yeah, do keep the questions coming. It adds a bit more depth to the session. So Nick, over to you.
Well, thanks very much, Tim and Katie. Yeah, as it's an election year, it was no surprise that what measures there were really mainly personal measures, and there's been precious little on corporate and business measures. But we've tried to eke out a few slides of what there is. But yes, it was very quiet on the corporation tax front. So just a reminder, the rates stay as they have been now since last year, 25% on corporation tax profits over £250,000, and that applies to your whole profits. And if your profits are under 50,000, it's 19%, and if you make profits somewhere between 50 and 250, you effectively pay at a blended rate on a sliding scale between 19 and 25%. So those rates are confirmed as continuing from 1st of April 2024. Moving on to capital allowances and what we know as full expensing. So this is a measure that was introduced 12 months ago, following the super deduction, which came in as a COVID relief. Full expensing came in last year to say that you could essentially, on a lot of expenditure on new assets, you could claim full immediate relief. That was initially introduced as a temporary measure for 3 years, and then in the autumn statement last year, the Chancellor made that permanent. So we now have a permanent full expensing regime, allowing for immediate year one tax deduction on most capital expenditure. What the Chancellor announced yesterday is that they're looking to extend this to leased assets. So businesses that acquire assets that they then lease out. So it might apply to particular sectors like businesses that acquire a lot of trailers and trucks that they then rent out to individual businesses and rent from them. I mean, really, I'm not sure how sincere all this is, because they've just said they're going to have a look at it and will proceed if it can be afforded, which is probably pretty much the same for all measures really. But they are particularly looking at that and seeing if they can extend the capital allowances regime to those businesses which acquire assets that they then lease out. So that was the announcement.
Just a couple of questions on those first couple of bits. So firstly, on the corporate tax rates, hopefully a straightforward one. Non-resident companies that pay UK corporate tax, presumably if they've got UK real estate or they've got a UK place of business, what would be the rate of tax applicable to non-resident companies paying UK tax?
Well, the rates are still the same for sort of UK permanent establishments, if you like, of overseas entities. They pay corporation tax in the same way, as at the same rates as UK incorporated companies.
So there's nothing that I can think of that would deprive a non-resident company of the 19% rate if it had low profits and otherwise qualified. Okay. And then another one, much more complex question, and probably one we won't fully flesh out in this session, but the full expensing still only applies to companies. Partnerships don't qualify for full expensing. So this extension, or the intended extension to leased assets, is there any opportunity there for partnerships to acquire their assets through companies and lease them to the partnership? Do you think that will be something that will be possible in the future?
So full expensing was introduced to soften the blow for increase in corporation tax, which applies to companies for the increase in corporation tax from 19 to 25%. So the full expensing rules does just apply to companies. Unincorporated businesses, partnerships don't get the benefit of full expensing. They do get the benefit of the annual investment allowance, but that's only a £1 million limit. So if you're a partnership, for example, that spends spends a one-off £5 million a year on an office fit out, for example, you'd only get access to the £1 million annual investment allowance, and not the additional £4 million to take you to £5 million of full expensing. I suppose there may be an opportunity for partnerships to look at thinking about setting up companies now that we might have this introduction of the leased asset rules for the company to acquire it and then lease it to the partnership. But I suspect that we don't have any draft legislation at the moment. I suspect there'll be anti-avoidance around that to stop you doing that in a sort of group situation, if you like.
Yeah, it's worth keeping an eye on, but it's the sort of thing that feels like it probably won't work in the full details available.
So moving on from full expensing, the only real measures around corporation tax that were actually introduced and are coming in, and we know are definitely coming in, are around the creative sector, so the particular sector that works in theatres, orchestras, museums and galleries. Now the rates of tax credit that those businesses that operate in that sector, the rates of tax credit had already been significantly increased, but only on a temporary basis. So prior to COVID, that column where you see current rates was the rates were much more around sort of 25% tax credits, 20% tax credits. They were increased during COVID and after COVID to encourage investment in that sector. But the government's now announced that there'll be some permanent rates set from 1st of April 2025 onwards for the businesses in those sectors and the tax credits that they can gain. And this is in the bottom two, the museums, galleries, exhibitions. Those reliefs were due to come to an end actually now, but the government's now committed to the relief on a full-time permanent basis. Couple of other things that are being introduced. There's going to be a new independent film tax credit, which is an extension of the audio-visual expenditure credit, which is for sort of film, animated TV, cartoons, and so on. The basic credit available in that sector is 34% or 39% for animated films. But if you fulfil certain conditions, which is essentially that you're an independent film with a budget of less than £15 million, and that you meet some British Film Institute conditions, so sort of Britishness, if you like, around the film, then your tax credit is going to increase from 34 to 53%. So it's sort of big encouragement there for investment in independent British films. There's one other measure being introduced on the creative sector reliefs, which is an extension of the audio-visual expenditure credit, which is just on the next slide, Katy, which is that if you're spending money on visual effects in particular, your credit will be 39% rather than 34%. So I guess a continued message is there, continued encouragement of the creative sector in the post-COVID world, permanent higher rates of credit available for that sector. Now, if you want to listen to a bit more detail on that, we have got our sort of media sector webinar, which is next Wednesday, where we'll go into these in a lot more detail. There was only one VAT, one mainstream VAT measure of note, which is the increase in the VAT threshold from £85,000 to £90,000. Now, given this had been frozen for 7 years, and we've had at least 20% inflation in that 7 years, that feels like rather a small increase to me. But nevertheless, there is an increase in the VAT threshold, VAT registration threshold, from £85,000 to £90,000. And then finally, just to mention a couple of other measures that have come in, the energy profits levy, which is a levy that applies in that sector for the sort of super profits that the energy companies are making, given the high prices of sort of oil and gas. That was due to finish on, that's a 35% additional tax on top of the 25% tax that they're already paying on their profits. That was due to end in the 31st of March 2028. It's now been extended for a further year to 2029. The economic crime levy, which is a levy that every business has to pay if they're subject to anti-money laundering regulations. The government's announced that it hasn't quite made as much money as it was planning to from that levy. So if you're a very large business, which for these purposes is turnover in excess of £1 billion, you will that levy will increase from £250,000 a year to £500,000 a year. So reasonably significant, a doubling of the levy for very large businesses. Free ports tax relief. That's additional tax reliefs for available for businesses who are operating in free ports. The claim window has been extended there, so some additional good news, I guess, for those businesses. And finally, there's possible implementation of the crypto assets reporting framework, which is an OECD initiative to encourage the international exchange of details on crypto assets. But that's it on business taxation. I said it was relatively light on detail, both in the Chancellor's statement and in the papers that were released afterwards.
Well, thanks, Nick. Well done for ploughing on through the bout of flu you have as well. So I'm just going to wrap up. We've got a few minutes, so do keep the questions coming if anything else comes up. With a pre-election budget, we do often see a steering towards measures that affect individuals rather than businesses. And also measures for businesses can be very, very expensive. So with little headroom, fiscal headroom to actually do a lot, all of the firepower was more or less directed at the 2% national insurance cut, which is costing £10 billion a year for as long as it's in place. Katy, if you just flip on to the next slide. So there's only 2 slides I've got to go. One is our traditional slide, just explaining, the effective rates of taking money out of your own company. So these effective tax rates cater for the corporation tax paid, the employer's national insurance paid, income tax, and national insurance. So if you're at the basic rate level, even with the national insurance cut, the 2% national insurance cut, which is predominantly only affecting basic rate taxpayers. Higher rate taxpayers pay the flat rate of 2% national insurance on income in those thresholds. So for basic rate payers, even with the national insurance cut, it's still cheaper in tax terms to take money out of a company as a dividend. So salary is the more expensive thing to do, and that's because 6% national insurance is still a chunk on top of your income tax rate. I've got LLP at the bottom, in as much as that's 20% income tax and 6% national insurance. Yes, so it's 8% for an employee, 6% for the self-employed. So self-employed people and people in partnership pay the lowest overall tax rate, and salary for a basic rate taxpayer is the highest overall tax rate. LLPs win across all the tax rates, or self-employed, but of course with the higher tax on retained profits, which is why not every business is an LLP. But at the higher rates, the 40% rate and the 45% taxpayers, we're in this rather curious situation where salary is the lower tax rate in most cases. The only thing that beats salary, ignoring LLPs, are the very small companies with less than £50,000 of profit. So almost in living memory, salary has always been the most expensive way to take money out of a business, but not anymore. And that's partly because the rates of tax on dividends have gone up. So we're ending up, there's not a lot in it, a few percentage points, but just bear in mind, if you are an owner-manager of a business and you've got the decision of how to take money out, whether as salary, as dividend, or something else, it's worth crunching the numbers, because some of the old logic that we all remember no longer holds true. Katy, we'll just do the last slide. The last slide, I've touched on it a few in my interruptions, that we do have an election this year. Depending on the budget bounce, I suspect a 2% national insurance cut is not going to give the current government a big enough budget bounce to call an early election. So I think the smart money's on an election later this year, October, November time. Labour have kept their cards very close to their chest on detailed tax policy. They waited to see what Conservatives would announce, which they now have shown their hand in the budget. Rachel Reeves has said a number of times that the Labour Party have no immediate plans to increase income tax, capital gains tax, or introduce a wealth tax, although these things are all still talked about. And I think people generally expect capital gains tax to increase at some point in the next electoral cycle if there's a change of government. That Rachel Reeves also said no change to the 25% corporation tax rate. Many people would like to see that reduced, but I think they're trying to sort of maintain some tax policy discipline and keep that rate in place for as long as they can, because we do need to replenish the Treasury coffers. They're one of their two leading tax policies, which they announced was 20% on private school fees. Conservatives were totally silent on that, so I think we can be fairly sure that under a Conservative government that wouldn't happen. But under a Labour government, I think it sits as near certain, and of course we can only change our VAT treatment of education costs because we're now free of the European Union rules. So under a Labour government, we're still expecting independent education to suffer VAT. Labour's other main tax policy, which was a clear blue sky between the Conservatives and the Labour policy, was the end of the non-dom rules. Well, as Katy alluded to, the Conservatives adopting a version of that as sort of really stolen the thunder of one of Labour's main tax policies. I think what we'll see in the sort of back rooms of the Labour Party is how they can take the Conservative Party amendments, which adopt a lot of what Labour were indicating they would do. Labour had indicated a 3 or 4 year period was under consideration, and Conservatives have gone for 4 years. I think they'll look at aspects of the Conservative Party's changes and want to toughen them up, just to show that their policy still has teeth. But we shall wait and see. It's considerable uncertainty for non-doms at the moment. And then the other policies that have been alluded to over the last year or so from the Labour Party, an additional, on top of the existing surcharge on overseas buyers, another 2% to discourage overseas buyers from buying UK real estate, to try and free up housing stock for people trying to live in the UK. And then a change to the way in which private equity fund managers are taxed. At the moment, they pay capital gains tax. A very famous quote from many years ago about a private equity fund manager saying they pay less tax than their cleaner, which brought many tax regimes to an end that they were relying on. There are a few that are still very beneficial in that area, and Labour have said they'll bring those tax regimes to an end for private equity as well. So that's what we know. I would have thought over the next few months we'll see a more detailed Labour tax plan, and we are running a session in the next few months on what the tax system and employment law and all sorts of other things would look like under a change of government. So we will cover those things in more detail. On that note, we're a few minutes early. I think we've answered all the questions that have come in. So we will continue in on our social media channels to give updates on these as further detail is available. Otherwise, it remains for me to thank Katy and Nick for their contributions and hard work overnight, burning the midnight oil. And thank all the attendees for great attendance for today, and thank you all for your questions. There'll be the normal follow-up that you'll receive, which will include a feedback form. We'll be pathetically grateful if you fill that out, as it really helps us shape the content and think about what we'll cover in future sessions. Otherwise, please enjoy the rest of your days. Thank you very much.